What is full reserve banking? In my last video, I talked about fractional reserve banking, which is when the bank holds a fraction of your deposit, called the reserve, and lends out the rest. And this system of banking has its disadvantages, such as how it artificially inflates the money supply, which leads to inflation and the devaluation of the currency you hold. And it's also vulnerable to bank runs. And what a bank run is, if you do not know, is when a large amount of people or a large amount of depositors simultaneously withdraw large amounts of money from the bank, and this can cause the bank to fail. But there is an alternative system of banking called full reserve banking. Full reserve banking is exactly what it sounds like, which is when you deposit money in the bank holds your full deposit in reserve instead of lending it out like it would in fractional reserve banking. Now, you may wonder how the bank would make money from your deposit if it cannot loan it out and collect interest. But under the full reserve banking model, you can have demand deposits and time deposits. And demand deposits are deposits where you can withdraw money anytime you want. And under full reserve banking, the bank would keep your full demand deposit in reserve and make it available for you for withdrawal anytime you want. And then there are time deposits. And what a time deposit is a deposit at the bank for a specified period of time, and you're not supposed to withdraw money from a time deposit until that time period has elapsed. And what the bank does with time deposits is that it loans it out and collects interest from these loans. And once that time period has elapsed, you can withdraw your time deposit, and you can withdraw the interest collected as well, the interest the bank provides you with these time deposits. And banks do offer interest for time deposits, and often the case, these interests are pretty good interest rates compared to regular interest rates under fractional reserve banking that are not specified for time deposits. So basically, for a time deposit, you are essentially lending money to the bank, and you can collect interest that the bank offers you from your loan. And for demand deposits, the bank is doing a service for the depositor, for you if you are depositing in a demand deposit. And the bank can charge a fee for this deposit because under full reserve banking, it cannot lend out this money and collect interest from these loans and make money from that. So it can collect a fee from a demand deposit, or it can require a depositor to make a certain amount of time deposits for certain periods of time in order for a demand deposit to be accepted without fees. So I moved inside because of the rain, but to continue with the topic, I can personally envision a full reserve banking system in which you can earn points for making time deposits that you can use in place of fees for your demand deposits. And compared to fractional reserve banking, the advantages of full reserve banking include how it does not artificially inflate the money supply, which would lead to inflation and would lead to the devaluation of the currency you hold, and how full reserve banking is not vulnerable to bank runs. And by that, I mean full reserve banks would not completely fail due to bank runs because they actually have the full deposits in reserve for people to withdraw from.